Is Florida's sunny rental market turning into a financial storm? In cities like Cape Coral and Naples, landlords are paying $7,800 to $20,000 a year just for insurance on homes that barely bring in $1,800 to $5,000 a month. Rents are dropping fast, down 8% to 12% year over year, while inventory has exploded by 65% to 118%, flooding the market with thousands of desperate listings. Some investors are losing $300 to $1,200 every single month on properties they thought would be gold mines. So, what went wrong? In today's video, we're diving into 10 Florida rental markets that are crashing hard in 2025, leaving landlords scrambling, properties flooding the market, and rents dropping like a rock. Number 10. Hollywood. Hollywood, but not the one in California. We're diving into Hollywood, Florida, a beachy paradise caught in a rental market storm. Picture this. Rents here have plunged by a steep 8% year over year, and investors? They're sprinting for the exits. Out of the 1,300 rentals currently on the market, a jaw-dropping 60% are investor-owned properties. That's not just a stat. It's a red flag waving in neon lights. Why? Because when investors start dumping properties, it's usually not because they're upgrading yachts. It's because they're bleeding money. During the pandemic, Hollywood became a magnet for first-time landlords, people from out of state who bought in without even visiting. It was all sunshine, spreadsheets, and sky-high rent projections. But fast forward to 2025, and those same buyers are waking up to a harsh reality. Rents are falling, vacancies are rising, and their dream investments are turning into financial nightmares. Hollywood's inventory has exploded by 83% compared to last year. That's almost double the listings in just 12 months. That kind of jump signals massive oversupply, which almost always means falling prices and panicked sellers. What's worse, these aren't big corporations with deep pockets. Many of these properties were bought by mom-and-pop investors, some using savings or retirement funds. So when rent checks stop covering mortgage payments, property taxes, insurance, which has soared across Florida, and maintenance, it's game over. Right now, the average rent sits at $2,750, but the competition is fierce, and many units are sitting vacant for weeks, even months. So yeah, Hollywood may still have its iconic Broadwalk and beautiful beaches, but behind the palm trees and pastel condos, there's a rental crisis unraveling in real time. Number 9. Boca Raton. Boca Raton, where the palm trees sway over luxury yachts and the real estate used to print money. But in 2025, even the high rollers are feeling the pinch. Rents in Boca have taken a steep 12% dive, with the luxury segment leading the collapse. Homes that used to rent for $5,500 a month are now struggling to fetch $4,000. And those elegant waterfront properties? They're sitting idle for an average of 189 days, double the wait time from last year. Inventory has jumped a hefty 68%, with 1,067 rental listings currently on the market. Many are leftovers from the pandemic migration wave when wealthy buyers from New York, California, and Illinois rushed in like it was a tax haven gold rush. But guess what? That wave is receding. Families are heading back north, citing soaring insurance rates, crumbling ROI, and homes that cost a fortune to maintain. And insurance? In many cases, it's up over 50% since 2022, eating up thousands in profits annually. The average rent now hovers around $3,200, and that's after landlords throw in perks like free landscaping or waived association fees. One local broker even joked, "It's like a clearance sale at Saks, only with million-dollar homes." The oversupply is starting to weigh heavy, and it's not just affecting landlords. Home values are beginning to soften too. What's happening in Boca Raton is a clear signal. When even the ultra-wealthy feel the sting, the market's turning fast. It's not just a ripple, it's a shift in investor confidence. The bubble of endless demand has popped, and for many high-end landlords, the dream of passive income is now a balancing act of holding costs and hope. Number 8. Cape Coral. Cape Coral was supposed to be Florida's comeback kid, a sunny paradise rebuilding stronger after Hurricane Ian. But in 2025, The rental market here is unraveling faster than anyone expected. Rents are down 9% year over year, and inventory is flooding the market with a mind-blowing 14,494 rentals currently up for grabs. That's not a typo. It's one of the highest rental inventories in the entire state. The average rent now sits at $2,291, but landlords are practically begging for tenants. And it's no wonder. Insurance premiums have more than doubled since the hurricane. Some investors report paying $7,800 annually to insure properties that rent for less than $1,800 a month. That's not just a bad deal. It's a financial disaster in slow motion. What's even scarier? Many of these properties are owned by everyday people, not hedge funds. Folks who bought during the reconstruction boom, hoping to cash in on rising rents and low interest rates. But now, with mortgage rates hovering above 7%, skyrocketing HOA fees, and steep maintenance costs, their dreams of rental riches are sinking like a leaky boat in the Gulf. And if you're wondering why the listings exploded by 86%, it's simple. Nearly everyone's trying to sell at once. It's a race to beat the next price drop. As more homes hit the market, prices soften, investor confidence tanks, and the cycle repeats. But here's the twist. Cape Coral still looks affordable on paper, especially compared to Miami or Naples. That illusion is keeping some buyers interested, but savvy investors know the math doesn't lie. Unless insurance rates come down and rent rebounds, the risk is towering. Number 7. Miami. If you thought Miami was untouchable, think again. For years, this sun-soaked global hotspot defied every housing downturn, boosted by international demand, crypto millionaires, and flashy Instagram lifestyles. But in 2025, even Miami is feeling the squeeze. Rents are down 5% overall, and in the condo market, once the crown jewel, they've dropped 6.2% year over year. It's not a free fall yet, but it's a sharp pivot for a city used to defying gravity. Inventory is surging. There are now 569 condo rentals on the market, and condo inventory for sale is up a staggering 118%. That means investors, especially foreign ones, are hitting the brakes. The strong US dollar has made Miami real estate more expensive for overseas buyers, and economic uncertainty abroad is dampening demand. Add to that the eye-popping 65% increase in insurance costs since 2021, and you've got a cocktail no investor wants to sip. With an average rent of $3,300, Miami is still pricey, but the cracks are showing. Landlords are offering concessions, cutting prices, and watching their HOA and insurance bills climb higher every quarter. A downtown investor recently told local media, "I'm losing money on 3 condos, rent's down, costs are up, and I can't refinance out of my 7.2% mortgage." This shift is especially jarring because Miami was the poster child for pandemic-era demand. Remember the headlines? Wall Street is moving to Miami. Now, some of those same folks are moving back or selling fast. What used to be a reliable high-end cash cow is turning into a money pit for many. Number 6. Fort Myers. 5 years ago, Fort Myers was a rental investor's dream. Palm-lined boulevards, seasonal snowbird demand, low prices, it checked every box. But in 2025, that dream has flipped into a full-blown nightmare. Rents in Fort Myers have dropped by 8.2% year over year, and many landlords are now bleeding hundreds per month. The average rent is now $2,245, but that number means little when insurance and property taxes have tripled since 2021. Back in the glory days, investors here were pulling in $500 to $600 in monthly positive cash flow. Today, those same properties are losing $300 to $400 a month. That's a swing of nearly $1,000 per unit. And it's not because tenants disappeared, it's because the costs have ballooned. One local landlord said, "My insurance premium went from $2,400 to $7,000 in 3 years. I didn't budget for that kind of jump. Nobody did." Right now, there are 1,578 rental listings in Fort Myers, an inventory surge of 74% compared to last year. The wave of post-hurricane reconstruction briefly masked the cracks, but now the truth is out. Many of those income properties aren't generating income at all. They're becoming financial anchors dragging investors down. Fort Myers also relies heavily on tourism and snowbirds, which means the off-season is getting longer and leaner. With Florida's broader insurance crisis and recession whispers in the air, demand is cooling and confidence is wavering. Properties that once rented in 3 days now sit for 3 weeks or more. This market didn't collapse overnight. It's been a slow grind from cash cow to cash drain. And the big risk? We haven't hit bottom yet. More investors are getting desperate, slashing prices, and listing homes at a loss. Number 5. Jacksonville. Jacksonville was never supposed to be on this list. This was Florida's so-called safe rental market, a blue-collar city with a strong military presence, stable economy, and affordable housing. But here we are in 2025, and rents have dropped 5.8%, while landlords across the city are quietly bleeding out. It's not making national headlines like Miami or Tampa, but beneath the surface, there's trouble brewing. With an average rent of $1,600, Jacksonville still looks attractive on paper. But don't let the low prices fool you. The real killer here is cost creep. Insurance premiums in the city have jumped a whopping 32% year over year, property taxes are up, and mortgage rates remain stuck above 7%. Suddenly, those once solid cash flow properties are turning upside down. Right now, the rental inventory is up 79% compared to 2024, and there are 3,424 active listings on the market. That's a serious spike in supply. And where's it coming from? Disillusioned landlords. A local agent said nearly 40% of their listings are from investors trying to bail out before things get worse. Some are small-time owners with just 1 or 2 properties. They bought during the low-rate boom, maybe fixed them up, expected solid long-term returns, but didn't plan for a market this brutal. Even the presence of military bases like NAS Jacksonville hasn't kept things afloat. It's like the floor dropped out quietly. No one's panicking, but the for-sale signs are multiplying. And what's especially concerning? These aren't luxury homes. They're bread-and-butter rentals. When this tier of the market cracks, it's a warning signal for everyone. Number 4. Naples. Naples, the jewel of Florida's Gulf Coast. Elegant streets, palm-lined avenues, multi-million-dollar mansions, Bentleys in the Publix parking lot. It's long been the go-to for retirees and second home buyers with deep pockets. But in 2025, even Naples is cracking. Rents are down 10%, and in the luxury segment, some properties are seeing drops of up to 20%. That's not just a correction. That's a luxury freefall. Let's talk about the shocker. Inventory is up 94% year over year. Nearly 3,833 properties are listed right now, and many are sitting. Why? Because landlords are facing insurance costs that are completely unmanageable. Premiums here have surged to $15,000 to $20,000 per year, especially for high-end homes near the coast. Imagine paying that to insure a property that rents for $5,900 a month, if you can even get a tenant. And that's the real twist. Naples didn't slow gradually, it flipped almost overnight. In late 2023, rental prices were still inching upward. By early 2025, the market flipped like a switch. High-income tenants are drying up, snowbird demand is cooling, and the flood of investors from 2020 to 2022, many of them are now panic selling before the bottom drops out. Here's the math problem. You bought a $2 million property with a 7% mortgage, $20,000 in insurance, $30,000 in property taxes, and you're renting it for $6,000 a month? That's not cash flow, that's financial roulette. Many of these landlords are now listing at a loss, hoping just to escape. Naples was built on the idea that luxury demand never fades, but even the rich are rethinking their Florida plans. Number 3. Sarasota. Sarasota used to feel untouchable. White sand beaches, boutique galleries, rooftop cocktail bars, and just the right dose of bougie charm. It was Florida's perfect blend of upscale and laid back. But in 2025, the luxury bubble has officially burst. Rents are down 7.5% across the board, and in the high-end segment, some landlords are watching their prices plummet by 15% or more. The inventory is flooding in, with 1,352 active rental listings, an 88% surge compared to last year. And that's not just coincidence, it's panic. A massive portion of this inventory comes from short-term rental investors and retirees who piled in during the 2020 to 2022 pandemic surge. Back then, cap rates were healthy. 7 to 8% returns were the norm. But now, a local analyst says many investors are barely pulling in 3.4%, and that's before accounting for soaring insurance and property taxes. Speaking of insurance, it's doubled in just 2 years. Imagine owning a $1.2 million luxury condo that once made $4,000 a month in rent, now bringing in $3,400 while you pay nearly $10,000 a year just in insurance. You're not winning, you're surviving. And here's where it really stings. Many of these owners are everyday people, not developers, not mega corporations. We're talking teachers, retirees, and remote workers who sunk their life savings into what seemed like a bulletproof investment. Now they're calling foreclosure attorneys. One firm reported a 300% increase in Sarasota landlord consultations since mid-2024. If you're a tenant, there's never been a better time to strike a deal in one of Florida's most desirable cities. But for landlords, the dream of owning a cash-flowing slice of paradise is quickly turning into an expensive lesson in overconfidence. Number 2. Orlando. Orlando, where pixie dust once made rental profits magically appear, but in 2025, that sparkle has fizzled out. This tourist-driven powerhouse is facing a sharp correction. Rents are down 7.5% year over year, and landlords who once rode the post-COVID travel surge are now grappling with brutal losses. There are now 2,645 rental units listed across the city, a 72% jump from a year ago. That's not a blip. That's a wave of investor panic flooding the market. The biggest hit came from short-term rentals. Remember when everyone bought Airbnbs here thinking they'd be booked 24/7? Those days are gone. Occupancy rates plunged from 80% in 2022 to just 58% now, and with inflation hitting travel budgets, many tourists are skipping Orlando altogether. Now investors are scrambling to convert Airbnbs into long-term rentals, and that massive influx is crushing rental rates citywide. The math is brutal. A landlord with 5 properties says he's bleeding $1,200 per month. Insurance costs have skyrocketed 24% year over year, and with mortgage rates hovering around 7%, many owners can't keep up. Homes that once rented for $3,000 are now sitting at $2,200 and still getting no bites. Even proximity to Disney and Universal isn't saving landlords. Some are offering 2 months of free rent, waived application fees, or discounted utilities, anything to attract tenants. And with residential inventory up 72%, buyers and renters have the upper hand. If you're a tenant, this is your playground. But if you're a landlord who bought during the hype, you're likely stuck between a rock and a very expensive mortgage. What used to be Florida's most reliable rental market has officially joined the list of high-risk zones. Number 1. Tampa. Tampa, the epicenter, the absolute ground zero of Florida's 2025 rental market meltdown. If there's one city that tells the full story of investor heartbreak, it's this one. Rents have dropped a staggering 8% year over year, and the effects are rippling across the entire region. Tampa now has 1,791 rentals on the market, and inventory is up a jaw-dropping 65% compared to last year. That's a flood of listings from landlords who just can't hang on. Here's the twist. Tampa was a pandemic-era gold rush. Between 2020 and 2022, rent prices soared by over 40%, luring in thousands of investors who believed the boom would last forever. Many bought at peak prices, convinced that rising rents would cover mortgages, taxes, insurance, you name it. But now, that fantasy is crashing into reality. The average rent in Tampa is now $2,275, but for most landlords, that's not even close to covering costs. Many bought with 3% mortgages, but those who refinanced or purchased recently, they're facing 7% plus interest rates, plus insurance premiums that have doubled in just 24 months. Toss in rising property taxes and HOA fees, and it's no surprise that dozens of properties are hitting the market every week, many at a loss. And it's not just one segment of the market. From downtown condos to suburban townhomes, everything's being affected. Investors are slashing prices, offering perks, even selling fully furnished units just to break even. A local property manager put it bluntly, "We've never had this much inventory. It's like a full-on landlord exodus." What makes Tampa number one on this list isn't just the numbers, it's how fast and far it's fallen. A city that once led the nation in rent growth is now leading it in losses. For renters, it's bargain city. For investors, especially those who bet big in 2021 or 2022, it's game over. Tampa is the ultimate cautionary tale of what happens when a red-hot market gets hit by rising rates, surging costs, and a cold dose of reality, all at once.